Is the stock market going to crash? This video has a ton of facts and insights, so I highly recommend watching the entire video and even rewatching it if you haven't already done so. Literally every day you will find countless stories about an imminent stock market crash happening. Go search for it right now after you watch this video. Not right now, don't do it until after you watch this video. You will find all kinds of people saying a crash is imminent. And the truth is, eventually these folks will indeed be right. One day. The stock market crash will happen, and the reason I can say that with certainty is mainly because it indeed has happened many times throughout American and world history. If the stock market gets too hot and extended from what it really is worth, of course it indeed can crash, but who knows when that will happen? Absolutely no one. Before we get into what to do about a crash coming up, we should look into why the stock market will crash. Stock markets tend to crash because people forget to hit the like button and subscribe. You definitely have to hit the like button. Be sure to hit the like button as it definitely helps with the Google algorithm. So the reason I bring this up is because when this stock market crash one day happens, the media will try to come up with some narrative explaining why the market crashed. They will say it is because we have too much debt, too much greed, trade tensions, because Congress did not pass a particular law, or anything else. But the truth is, if the market is indeed fragile, it doesn't matter what the event is. Eventually, the significant events would happen no matter what in any case. If a fragile bridge collapses because some animal bumps into it, did the bridge collapse because it is just a weak bridge, or did it collapse because an animal bumped into it? The truth is, it is important to focus on whether the stock market has a proper foundation or doesn't. That is literally something that you will have to think over and decide for yourself, because how can I do that for you? Let's look to see if the stock market has a proper foundation right now. But first, it is important to have a good foundation by hitting the like button. Stock market prices usually are based upon the price to earnings ratio. If you are paying 25 times earnings, one is literally paying the equivalent of 25 years worth of earnings for the stock at the moment. That can be expensive unless it is assumed that earnings are going to increase substantially in the intermediate future. The S&P price PE ratio averages about 14, usually. That's average, but it has been anywhere from a very expensive 40 during wildly optimistic time periods in the 1990s, or around 7 in a severe bear market. At the moment, the S&P ratio is 22. A lot of corporations also have quite a lot of debt. Corporate debt is currently at 48% of America's GDP. The peak corporate GDP was around 52% in 2008, and we all know what happened after that. So what do we do if the stock market is about to crash? Do we sell all of our stock? Again, I am not an investing professional. Never listen to people who make voiceovers on YouTube. We don't know what we're talking about. Consult your financial advisor and ask. Oh, and one random comment about financial advisors. Only go to one who gets paid by you on an hourly basis. Never go to a consultant who gets a commission to go against your interests. Okay, back with the program. So here are some suggestions if you think a stock market collapse is just about to happen. Number one, you can reduce your equity exposure. You can sell some stock and put into something that is liquid and will not go down as much or at all in the event that the stock market collapses. You can put the money in a high interest savings account. Number two, do you want no risk but still want potential stock market gains? Consider a market linked CD account. Typically, a CD account locks you into a fixed period of time, say 5 years, with a fixed interest rate. With a market-linked CD account, there is a fixed rate and a guaranteed protection of principal, but you do have the benefit of having an investment return in the event the stock market goes up during that time period, like 5 years. There are some negatives of this kind of investment you should consider, though, including there are penalties if you cash out prior to the maturity date. Your upside might be limited. There is a call risk in case your financial institution ends the CD prior to the maturity date. The lack of dividends, the treatment of the increase in your investment as an interest payment instead of capital gains, so that can affect your taxable income and tax rate. It is also possible that you will make less than a typical CD account, but at the very least, you won't lose your principal like you would in the event of a market crash. Number 3, you can consider buying actual gold and having it stored in a secured facility. In times of crisis, gold has a tendency to do rather well. The only risk is that you will have to pay a storage fee each year, and there is no dividends or interest payments on your gold, and of course, your gold could go down in value too. Number 4, I don't recommend shorting the indexes or trying to profit from a downtrend. I have lost a lot of money trying to time the market in terms of thinking I know exactly when it will crash, and so have my friends. So I think that even though it is certainly tempting to think that you will time the market perfectly, I don't think that this is ideal. Here are some other things I should mention. Over the long run, the stock market has a tendency to go up. Considering that we've been in a bull market for more than a decade, it is reasonable to be cautious. During the beginning of our present bull market, our stock market was roaring in the years 2009 and 2010. That is a time period when the stock market is recovering from its losses in 2008 and has the easiest time moving upward because a lot of the early investors are trying to scoop up shares as cheaply as possible. Now, after 10 long years, we're near the all-time high, so it might not be the best possible time to buy. If you're a market timer, you will of course want to wait until some lows are hit so that you can get better deals. That is how some investors like Jim Rogers tries to invest. He likes buying stocks at 15-year lows, so he will go around the world looking at stock markets that are severely depressed. Stocks can, of course, go up quite a lot after they've been depressed for a long time, but sometimes some stocks remain cheap forever and never recover. Many of the most sophisticated investors in the world have found that the current stock market has been one of the most confusing and complicated ever, so if you're confused, you have the company of the best of the best. So now is the perfect time to hit the like button, subscribe, hit that bell notification button, and leave your comments below and let me know what you think. I look forward to hearing from you.